Now, let's start off by doing a little bit of technical information. What is interesting about these regulations is that they are what's called proposed and temporary. Let's understand what those things mean. A proposed regulation means that the IRS is proposing that this is what they want to do. However, it is, because it is only proposed, we don't have to follow it. However, in this case, the IRS issued the regulations not only as proposed, but also said they are temporary regulations. Temporary regulations means they are now part of tax law. That means that which we are talking about today, and please understand these are very lengthy, very complicated regs, and we're going to kind of skim over the surface because I don't know the specifics of any of you, but these regulations are now in place. They went in place on January 1st, 2012, and they will be in place at least until December 31st, 2014. Right? So this is the law of the land as we stand today. Now, you should understand that there are various things, and we'll point out some of them, in the regulations that various organizations, including the AICPA, including the American Bar Association, American Bankers Association, and several other organizations, the Small Business Association, have really come down and said they disagree with and have done oral as well as written arguments to the IRS regarding this. Whether the IRS listens or not, we'll know in the next 9 to 12 months. Okay, why is this so important? This is going to be very important because as the regulations stand today, they are going to affect the vast majority of businesses, both real estate businesses and operating businesses. And we also have to remember that a lot of operating businesses use their own real estate. So a lot of our clients, for example, are using what's called owner-occupied real estate. So that those people have to understand that not only are they an operating business, they're also a real estate business. And a lot of people that are not owner-occupied have significant leases, and a lot of this will apply to your leasehold improvements. Right? So why do I care? Understand that there's a lot in tax law today that we don't understand. We don't know what's happening. But we're going to deal with it the way the tax law reads today. As of now, Section 179, which is the amount of any asset acquisition that you can expense immediately, is going to be cut in half from 2011 to 2012 and goes down even farther in 2013. We don't know if that's going to change, but this makes it more important because one of the things this tax law does is it makes requiring capitalization much more likely. So all of a sudden, if you're going to have to capitalize more and you can directly expense less, you're going to wind up with more that you have to you're going to have to depreciate and amortize over time. Second issue, bonus depreciation. Bonus depreciation in 2011 said that you could immediately expense any new assets that you purchased. In 2012, that goes down from all of it to half of it. So once again, we see that there is more that has to be capitalized. And very important is that as things stand today, leasehold improvements, restaurant real property, and retail real property, and certain other real property that used to have a 15-year life now has a 39-year life. So, for example, if you own a restaurant, all right, fast food or otherwise, and you build a new restaurant under certain circumstances, if you did that in 2011, you'd have a 15-year life. you do it in 2012, you're going to have a 39-year life. So all of a sudden, how much of that has to be expensed, how much of that has to be capitalized, becomes really, really important. And that's one of the reasons why we are looking at this. Now, what the law said is they clarified what is part of a building. Now, that sounds pretty silly. But what you have to remember is that very often when you purchased or constructed a building, and we're going to talk about real property first, when you built when you built a building, what you did is you went out what was known as a cost segregation study. And the people went out to a cost segregation study and they said, okay, we're going to take a lot of what you call real estate and break it out as personal property. What these regulations did is they said, wait, stop. Some of those things that you used to be able to call personal property and depreciate over 5 years, you can no longer do that. So, for example, all of the items that are listed here, plumbing, HVAC, electrical systems, elevators, escalators, fire protection and security systems, gas distribution systems, and just for good luck, anything else they feel like throwing in there, all of a sudden, that is considered real property, part of the building, 39-year life. All right, that's a major, major change. It's a clarification, but a major, major change, which is not good for us. Now, what is interesting in this is one of the things they did not include, and that's a roof. And I put this here because we are unsure whether or not the exclusion of a roof was intentional or accidental, because there are other parts of the code that actually call a roof as part of a building. It remains to be seen for clarification from the IRS whether or not they are considering a roof a severable part of the building. It is my understanding that it is severable, and we're going to talk about why that's important in a few minutes. Please understand that if the expenditure is an improvement to any part of a building, it must be treated as part of the building. So, for example, replacement of windows. Windows are part of the building. Therefore, when you put a new window in, it is a replacement. It's an improvement. You put new windows in because they are better windows. Therefore, it has to be capitalized. So anything that improves any part of the building has to be capitalized. Now, what that means is an expenditure that you make is more likely to be capitalized. Because it has to be capitalized in the real estate area, remember what we just said. Unless the law changes, you're going to be talking about something that is going to be depreciated, except for residential real estate. For commercial real estate, we're talking about a depreciable life of 39 years. That says that unless you do something that we're going to talk about in a minute, all you're going to get is regular depreciation for 39 years for every component of the business, of the real estate. So what happens? Let's suppose, for example, that you need a new air conditioning system. I am not a real estate person, but I can't imagine that the air conditioners that sit on top of our building are going to last for 39 years. I'm almost positive that a roof that sits on top of our building is not going to last for 39 years. So what happens when these things are disposed of, are replaced? This is where it gets to be very interesting. This is the importance of an entirely new area of segregation. Now, the cost segregation people, and there are specific companies that specialize in this area, this is called the Full Employment Cost Segregation Law. And the reason for that is what the law allows you to do is either when you're first building a building, or even if you're sitting in a building that you previously owned, you could go in and you can determine the cost of each part of the building. So that, for example, if our building, if our roof costs $200,000, and I have no idea what our roofs would cost. But if we know that we have to replace our roof, and the original roof would have cost $200,000, and it was being depreciated over 40 years, because I can't divide by 39, all right, that would be $50,000 a year, all right, every year. If it's 10 years down the road, that's $500,000 of depreciation, and it leaves me the rest that is as yet undepreciated. If I have segregated that cost of that portion of the building, when I put a new roof on, I can have to capitalize the cost of the new roof, but because I have segregated the cost of the roof, I can immediately expense that portion which has not been depreciated. All right? So let me repeat that. This is very, very important. This is why all the cost segregation organizations out there are also holding all of these seminars, because they want your business. If you go out to your building and you determine the cost of each component of the building, when you replace that component, you can then go in and you can expense the undepreciated portion of that. That is something that is new. We didn't have it before. It is extremely favorable. There are, I know of 4 or 5 highly qualified, very knowledgeable organizations that can do this. Gray is not one of them. It is not a service we provide. We'll be very happy to give you the names of people to do it that we trust, but it is not a service that we feel qualified to provide. But think about what it does. It is going to allow you to expense that component of the building when you're replacing it. All right, so that's extraordinarily important. All right, so is this the same thing as getting an old-fashioned cost study? No. This is an entirely different cost segregation study. The old cost segregation study was designed to take portions of a building and saying these portions of the building are real property, depreciated as real estate. These portions are not part of the building. It is tangible personal property and depreciated over a much shorter time frame. That's what the old cost seg study did. The new cost segregation study, on the other hand, is sitting here and taking that real estate, taking that building, and breaking the components down into the cost by component, so that when that component is fixed or replaced, you're going to be able to expense that portion. I don't know how much it's going to cost. I've spoken to some people, and their answer always is, we have to look at the building, we have to look at the plans. But it is clearly something that if you have a building and you are depreciating it, especially if it's over 39 years, this is absolutely something that we're going to want to do. And we're going to talk about some of the things that go into it in a little while. Leasehold improvements. Right? Gray does not own the building that we're in. All right? We lease it. So we have all kinds of leasehold improvements. Leasehold improvements are very important. If you go back and you think about what we talked about with 15-year life, one of the things that was in a 15-year life is leasehold improvements. So that basically what happens is in 2011, any leasehold improvements we made to our facility would have a 15-year life. Unless it's changed, any improvements we make to our facility this year is going to have a 39-year life. So as soon as we're talking about 39-year lives, once again, we're going to want to be able to break that down so that if we have to replace a portion of that, we're going to be able to expense the undepreciated portion. So that this applies not only to real estate that you own, either as a real estate professional or as owner-occupied real estate of your building. You're going to want to do this even if you're just leasing your building. You're going to want to take a long, hard look at what this does. Now, I haven't seen any questions, and I know I'm going very fast, and that's kind of deliberate, all right, because we're trying to just give you a flavor of what this is because we don't know your specifics. It is very, very important, especially for people with real estate, that you call us or somebody else that is qualified and really tell you how this is going to affect you. But anyone that has a building, all right, should really be going out, especially if that building is 39-year property, has really got to go out and have one of these specialized cost seg studies done. But we said this applies to all property, not only real property, but to tangible personal property. Tangible personal property is any hard asset, my desk, my chair, my cabinets, my computers, all of those things are tangible personal property. And we now have a definition of tangible personal property as to how the components work together. This is really important when we start talking about things, especially in the manufacturing area. So that what it says is all components that are functionally interdependent are considered one piece of tangible personal property. So that, for example, a conveyor belt, all right, with various machines attached to it, because they are all interdependent, are now one piece of equipment, not multiple pieces of equipment. Right? That's a very important distinction to make. Okay, so that's very important for us to understand when we start moving forward. So what happens when I do repairs and maintenance to my tangible personal property? Basically, anytime you are making what's called a betterment to a piece of tangible personal property, it has to be capitalized. What's a betterment? A betterment is something that fixes things to a material condition or fixes a defect. Now, you would think that if you bought a new piece of equipment and you had to do something to it in order to fix a defect in something that was purchased, you'd be able to expense it. The answer to that is no. Because you are taking that piece of machinery, that piece of equipment, and you are making it better, you are making it useful, you have to, Karen's laughing at me, you have to actually capitalize it as part of the cost of equipment. Okay? This is new. Anything that results in a material addition, an expansion, an extension, a physical enlargement of any type of machinery or piece of equipment is also now considered a betterment and has to be capitalized. Anything that results in a material increase in capacity, right? Something that makes it stronger, a new engine, new machinery, faster conveyor belt, new grills, all right? Grills that are hotter. Any of those things are now considered to be a betterment. And as a betterment, you have to capitalize it. We go back once again to the decrease in amount you can do in 179, the decrease that you can do with bonus depreciation. All of a sudden, we're talking about very significant amounts of betterments that are going to have to be capitalized and not be able to be expensed. Any payment that results in a betterment has to be capitalized. Anything that restores the property to its original condition. All right? So if you have again, we'll use the conveyor belt analysis. If you have a conveyor belt and you do something that it's been going for 3 or 4 years, and you do something to restore it to its original condition, such as replacing gears, replacing the belt that it's on, any of those things now have to be capitalized. Anything that adapts the property to a new or different use, even if it doesn't do any of the other things, has to be capitalized. Now, unfortunately, what we don't have here, after we talk about all of these things, there really is no super bright line test for betterment. There is still eye of the beholder. Now, the issue that I have here is that it's going to be the eye of the beholder when the IRS comes and looks at it. We don't have enough of a bright line test in the definition. Even with the things that I mentioned, we don't have enough of a background to be absolutely sure when we have a betterment. We would have preferred a bright line test. Several small business organizations and manufacturing organizations have made in-depth suggestions to the IRS for bright line tests. We'll have to see whether that comes to fruition. All right, hang on a minute. Let me read the question this here. Is adding a 30-amp circuit to an existing electrical system a leasehold improvement if the cost of adding that circuit exceeds the company's threshold policy? The answer to that would be yes. Absolutely. All right. Adding that would absolutely be part of the electrical system that we talked about previously. It's part of the electrical system. It's part of the building. You have a 39-year life. All right. And in the old days, a year ago, I would say that most people would have taken that 30-amp box and electrical wires and said that it was actually not part of real property, that it was actual tangible personal property written over 5 years. Now it's 39 years. Now, the good news, well, let's not say good news. Let's say the maybe news is that in their infinite wisdom, the IRS gave us what's called a de minimis test. All right? Now, a de minimis test means that the transaction or what we're looking at is so small that the IRS, in this case, has determined that it's not worth their time to look at it. Now, the first rule in order to be able to use the de minimis test is that the company has to issue what's called an applicable financial statement. An applicable financial statement, and please, I'm glad I'm not sitting in front of you. I'm glad I'm on the phone because you can't throw things at me. But an applicable financial statement is an audited financial statement by a CPA firm, and that financial statement is either used by a governmental agency, the SEC, or is used to obtain credit. If you don't have that, stop. You can't use this at all. Now, if you did that, and I'll get to the questions here in a minute. If you did that, the IRS says if your total depreciation is equal to 1% of gross receipts for the year, or, and this one makes no sense at all, or is 2% of the depreciation on the financial statement, if either of those is true, then they're not going to bother looking at it. But you have to start off with the audited financial statement. All right? Now, if in years before 2012, amounts were deducted that the regs would require to be capitalized, do we need to capitalize them now? No. Likewise, if a cost seg treated cost as personal property, do they need to be changed to real property? The answer is no. What you did prior to 2012, any property that you bought and however you classified it prior to 2012 is fine. This applies to expenditures, purchases of property in 2012 and 13. All right? We'll see what happens in 2014, but in all likelihood, these regs are going to be very similar to the way they are today. Now, we as accountants have to get into the act somewhere. I have to make sure that my wife and I can take our vacations. So basically what it says is if you go in, and let's go back to segregating the costs of a building. If you go back to segregating the cost of a building, and instead of taking the building as one unit, you're now taking it as different units. Right? You have the roof, you have windows, you have so on and so on, and you broke all of those down into different costs. In order to do that, the IRS says you have to do what's called a change in accounting method. Right? So basically what's going to happen is you're going to have to go and you're going to have to file a very specific form called a 3115 tax form. You're going to have to go, and it's a little bit cumbersome to fill out. It can be very cumbersome to fill out. My people here just corrected me. All right? And that's going to happen so that you'll be able to do that, which we said with dispositions. Please, 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 and I'm not just saying this because I know some of you are clients and I'm begging for fees. Please, please, please have a professional do these things. It has to be attached to your tax returns and all kinds of other things. It has to be done properly. Should be done by the professionals. So make sure that you're doing this. All the documents should be given to your accounting firm, and actually the entire cost seg. We would recommend that the specialized cost seg be coordinated through your accounting firm. But you can hire somebody to do it and give the information, or you can have it done as part of your accounting fee. And most accounting firms have people that will do that, not with their firm, but specialized firms to do it. But you're going to have to file that change in accounting method. All right. Long ago, 8 months ago, I used to tell clients that they ought to have a capitalization policy. And I said to people that you have to have a realistic capitalization policy, and that capitalization policy should say that, you know what, anything that you buy that is less than X, and because I'm a fairly conservative person, I used to say less than $1,000. I know people that said less than that, especially more than that, especially for large companies. You shouldn't bother with depreciation schedules. You should just immediately expense it as a supply and make it go away. Unfortunately, I can no longer say that, because as part of these regulations, we have a new definition of de minimis for materials and supplies that can be expensed immediately. And no, it is not a typo. It is $100 per item, not $1,000. And I will admit that $100 is indeed pretty de minimis. All right? But basically what they are saying is any expenditure that is more than $100, you're going to have to make the actual decision on whether or not you can expense it or not. And then once you expense it, we get into the entire question of whether we can use Section 179, what its life is, what we can do with bonus depreciation, and so on and so on. But basically we have a whole new regime here of what we can do, and my previous things, which I like to do, of saying you ought to have a capitalization policy of $1,000 or more, is out the window. The capitalization policy is now $100. Okay. So what is the materials and supplies? A material and supply can be expensed immediately. So let's look at what a material and supply actually is. A, it has to have a useful life, which means you have to replace it within 12 months of putting it into use. All right? It maintains or improves the unit of property, otherwise you wouldn't be doing it anyway. The other thing that is part of this are rotatable parts and temporary spare parts. A rotatable part is something, for example, tires, where you're constantly rotating tires in and out. All right? If that's the situation, they say that once you put it into place, because you are just rotating items around, you can expense the rotated item in. All right? That's rotatable parts. Now, are there any, and again, I'm on time. I wanted this to go over a half hour. Are there any, I know I've gone over this very quickly. The goal here today, these regulations are very long, very complex. The goal was to make it so that you have enough to sit down and say, yup, I've got a problem. I have to sit down and tell them exactly what my situation is. Are there any other questions I can answer before I get into my conclusions? Okay. Here comes my plug. Many of you know that for the last 23 years, this is year 24, we have had year-end tax seminars. And we now have 3 of them every year. We have one in Westboro, which is open to everyone. Clients, friends, a lot of bankers are there, a lot of insurance people are there, a lot of everybody is there. At our first Westboro seminar, it is open to everyone. That's on November 28th. Those of you that are our clients, we have a special seminar just for our clients. And we do that for a reason. We do that because basically that allows us to really get down and talk turkey and really say things that yeah, I'm not going to tell you that we're going to say anything that is wrong. We're not going to lead you in any false directions. But because we know bankers aren't there and the attorneys aren't there, and we've even had IRS agents on occasion at our regular seminars, we want to really talk about some of the things that are on the cutting edge of taxes. And by having clients only at that seminar, it allows us to do that. That seminar is on November 29th, again here at our Westwood offices. The last seminar is December 4th, again at our Westwood offices, and it's open to anyone. So it's November 28th in Westboro. It is, I forget the name of the hotel, I apologize, but it's at the hotel at the junction of Route 9 and 495 in Westboro. Our office is here in Westwood, 34 Southwest Park. Those of you that have been here, we have an outstanding training center, and we give you a very nice breakfast. And we get a chance to talk, and you can talk to me and other members of the tax department and my partners, and we can really talk about the specifics of the situation. That is our upcoming tax seminars, and we will really get into the detail. We've had several webinars. We're going to get into even more detail on some of those at the year-end tax seminars, as well as some of the other stuff that is bound to come up between now and after the elections. Okay? If you want to sign up for our newsletters, you want to see other things, go to our website. You can sign up for our newsletters. You can sign us for us, like us on Facebook, et cetera, et cetera. All right. My cell phone number is 617-775-2129. I answer my cell phone just about all the time, anywhere I am. When I'm up in New Hampshire, though some of you know, the magnificent Tina and I have a place up in Waterville Valley, New Hampshire. When I'm playing tennis, I don't answer the phone. And if I'm working out at the gym, I don't answer the phone. However, when I'm skiing, I do answer the phone. When I'm hiking, I answer the phone. So, you can feel free to call me just about any time. If you have questions, you can call me on my cell phone. That's my email address. You can email me. I tend to get into the office usually by 6:15. I tend to answer the phone until about 7:30 when other people get here to answer it. So if you want to just talk to me, you can call very early in the morning, and we can talk about any of these things. There's our lovely disclaimer that the attorneys all make us put in there. Are there any other questions? I know I just did this superficially. The intent was to do this superficially because there's so much to cover, and the effect of it is so different from company to company that we decided to do this fairly superficially, as well as because the regulations are in proposed form, and they may still change. We just want to tell you what is out there. But remember, even though they are proposed, they are also temporary. They are the law of the land. Anything that you added this year or next year has got to comply with these regulations. If you are dealing in a building environment, a real property environment, we do strongly suggest that you have the new cost seg studies done. All right? I guess with that, I want to thank you. If there's any questions, give me a call, send me an email. I don't see anything else on the board. Thank you very much, and I hope to see you in November. Bye-bye.